Hi, this is Kim Watson. In this video, I just really want to cover tomorrow's non-farm payrolls, or if you're watching this on Friday, today's non-farm payrolls. So, what's the score then? Well, firstly, why are they so important? Well, the non-farms are generally an important bit of information each month, regardless of the state of the economy or whatever's happening. When wage inflation starts pushing up really high and that you've got quite strong employment numbers, it means that consumers are more likely to be spending higher, and at such point they create much more demand and inflation, and at some point that can become a bubble. So the Fed tend to soften that down by increasing interest rates, which slows things down again. So it sort of it eases back on the bubble. However, obviously we've been through a very difficult period. In this particular case, though, now the Fed have promised these sort of long-term, or discussed these long-term financial easing, which will go on for some years, but they're not even really wanting to talk about tapering or anything else but fiscal easing, and it really came over last month. In the numbers that were there. Now they have stated that fiscal easing will continue until they see full employment, and that is what they've put there at the moment. Well, we'll see how that pans out. There are tensions between those looking for full employment and those that say price stability is essential. And if inflation runs too high, they believe that it might not just be a short-term aspect of inflation, but also the knock-on effect to other market, the bond market, etc. And it could create a significant impact on the financial system again. So there is this real risk of letting inflation run too quickly. When we look back at pre-COVID times, the focus has moved from full employment then to wage inflation, but we're not to that wage inflation at the moment. Wage inflation is still looks quite poor. Looking at the previous figures there, and no surprise that when it was comparing like with like, that wages just weren't moving. However, there is more call for wage inflation as well. Now the Fed is saying for now inflation will be temporary, and it will continue to increase before it dips again. They're expecting this dip, and to be fair, the reason why they believe it's transitory is we're comparing an economy that was on its knees last year, and now we're comparing, when you're looking at inflation and looking at the percentage increases, you're comparing with last year, 12 months ago, and this month. So yes, if everything was shut down a year ago, inflation is bound to be higher, full stop. Yeah, if people are now allowed to get out and buying, it's going to be a difference. And as the market's moving back and back, and the US have been quite good in more recent times with their vaccinations, they're getting their market back and growing. So we're going to see these periods of much higher demand, but you're not necessarily comparing apples with apples, as I've said. Some, though, are not convinced. They believe that the stance the Fed should take is likely to damage the economy, as I've mentioned, with the risk to the bond markets and other markets out there. We could see quite a change at some stage if it's not managed carefully. Current president's thrown his oar into this in terms of saying he wants to see wage growth. He believes that this can happen without it being passed on in the longer term. I think it's going to be tight not to pass it on in the short term, and most analysts that are out there will look at wage growth and assume that it will, in the current stage of things, with demand being high, wage growth will just be passed on to the consumers. Now there are supply issues which will put pressure on inflation, of course. Low inventories, with businesses not being working, the inventories have been reduced, so low stocks. Demand is high relatively, and causing more demand allows sellers to put the prices up more. Workers are not all back. There's still some that are not back until I think about September time, or due back to around about that time. So there's still scope not to see such a massive increase in the numbers of working that are actually back to work. And of course there are some people that have just sat back for now. there is this whole thing in wages. Is that I was listening to something the other day, and there's sort of there hasn't been any real wage growth since the 70s, when after which there's always been these reasons why that it should be pinned back, and it's been largely more to inflation at the time, but not necessarily in line with inflation all the time. But the true real wage increases haven't happened for a significant amount of time. And of course, since 2008, it's not happened. For many 2007, 2008. So what traders be looking for in the upcoming data? Well, the headline is the new jobs created. Now, last time it was supposed to be a million, around about a million, and it came in at 266. Now, there was a whole sort of kerfuffle around the numbers and the sort of the seasonal adjustments that went on, and the bottom line underneath there somewhere, there was a million jobs created, but by the time you take in this into terms the seasonal adjustments, it come down to 266, which really helped the Fed at the time, because they were saying we need more time, we don't want to be doing anything, and that's really helped things. This time the expectation is a lot lower. It's expected at 645 to 650. I've read on ING Banking, I think it was, that they're thinking more like the 500,000. So there's this sort of quite range between 500,000 650. I'm sure there's other banks that are out there that are looking at sort of figures in between that, or maybe more, maybe less. So what happened last time? Well, we know, as I said, we instead of getting a million, it got 266 in price terms. It was on about an 85 pip move straight away in the first few minutes that came after that. So that's what's happened. We can't necessarily say that's going to happen again, but what we can look at is what to expect. So we see a miss this time. Again, if the miss is significant, probably a couple of 100,000 difference, or even if it's a bit just slightly less, that the 650, that sort of 645, 650 should be priced into the market, and there's an expectation that would be priced in. If it's not today, towards the time that will be fully priced into the market. So anything that's sort of quite a distance away from that will create some more volatility. Now, again, if it's quite a lot lower, I would expect the dollar to be sold. Again, if we see something better, expect the dollar to be bought. Now, what are the best currencies against these? Well, if the dollar's sold, the Canadian dollar, well, there's a few currencies, the Norwegian krona, Canadian dollar, and maybe even the New Zealand dollar may see the best out of it. The pound could see pretty well out of it in terms of tapering as well. So there's a few. Of course, the euro, we'll see how well the Euro ECB managed to hold things back. They're in the same sort of boat though, in terms of being forced to end tapering or to discuss ending tapering. So that could actually also see the euro push up quite strongly if the dollar misses, if the figures miss. If, however, they get in better than expected, the best move possibly would be with the yen, with the currencies that are less and more likely to stay where they are for a lot longer. So the yen may be the biggest loser against the dollar, so we'll see the dollar yen pushing up effectively. So that's my sort of expectations for tomorrow. I expect there will be very quiet markets in the morning. If you're trying to trade the morning, we could see some very low volume moves that sort of kick through there at the moment. And I was just looking at the markets today, and the euro's being sold off at this stage, and it could be quite a catalyst. What we see here, it could be a beginning of a bit more of a catalyst. So if we see that miss for the dollar, well, perhaps it won't be such a catalyst. The euro could just bounce and continue in its trend. The S&Ps, etc., will continue pushing up. If, however, we see quite a swing the other way and more jobs created and moved in, the dollar will no doubt strengthen, like the S&Ps. I would expect to soften up a little bit there. It will put pressure on bonds, for example. I should imagine the yields will push up quite strongly, at least to start with. So there's a few areas where we'll see some volatility. Anyway, I hope that helps, and I wish you all the best for post-trading, it may be, or the days after it. Take care. and trade it safely.